good evening, everybody, and welcome to the March version, March 2021 of the Investing Roundtable. We're sponsored by Better Investing, Mid-Michigan chapter, and Manifest Investing. And my name is Ken Kavula. I'm a director with the Mid-Michigan chapter of Better Investing, and I'm joined this evening by my good friends, Kim Butcher, she's down in Florida, Cy Lynch from Atlanta, Hugh McManus from out in Pasadena, California, and Mark Robertson from about 45 miles south of me in Rochester Hills, Michigan. I live up near the Saginaw Bay area, and together we put on this program once a month. We've been doing it for more than 11 years right now, so we're moving into our 12th year of roundtable decisions. And as long as we're having a little bit of fun with it, we plan to continue the program. So good evening, gentlemen. Thank you for all being here. Good evening, Kim, one of our damsels, and we're especially happy to see you with us this evening. And let's get started. We have some legal stuff to get out of the way pretty quickly.
Wait, Ken. I wanted to point out the cover slide.
Okay, go ahead, Mark. Point it out.
It's just my way of date stamping tonight's session. I think most everybody here is at least tangentially aware of the GameStop situation. And if you follow it closely, the people on Reddit and on some of the social media, they talk about flying to the moon, and they use emojis in the shape of rocket ships and stuff. And I just wanted to point out that the Better Investing community was already on this trek back in 2014. So we're 7 years ahead of all this stuff that's going on. So I thought we would celebrate that.
The only problem is, Mark, our point would be a lot stronger if it wasn't a magazine cover, you know?
It's the best I could do, guys. Go ahead. You just rain on my parade.
We have some legal stuff to get out of the way. Just like always, we're going to mention specific stocks this evening, and we're going to have some opinions about those stocks. In no way should you construe those opinions as being recommendations to buy, sell, or hold. This is an educational demonstration, and it's an enlightening demonstration that's been going on for a while. The opinions expressed are those of our panelists, our commentators, our guests, our participants, and whoever else might wish to speak during the evening. We might hold some of the securities we talk about in our personal portfolios, and if we're getting some feedback, guys.
Let me see if I can identify that.
And if we can remember, we'll let you know when we hold particular stocks. If you'd like to get reminders about the roundtable, you can drop a note to my wife, nkavula1 at comcast.net, and she'll send you instructions on how to sign up for our guest list. Or if you're brave enough, you can go directly to the Better Investing website, find the Mid-Michigan chapter, and then on the homepage, you'll find a place where you can add your name to our guest list as well. We inform our guest list once a month about the date of the roundtable and any other programs we might be running for free. And then we invite you to register if you wish. That's all that will bother you, is once a month. Well, that won't bother you more than that. You can also get copies of slides, or if you have questions about the presentation, from Mark, and Mark's email address is markr@manifestinvesting.com. Our agenda stays pretty much the same month to month. We're going to look at our performance. We're going to see if there's any of our stocks that need challenging and might need removal from our tracking portfolio. We have 5 stocks this evening we're going to present. Notice that Cy and myself have both chosen the same stock. That was done completely independently. So it'll be interesting to see how well our 2 presentations dovetail with each other. We'll allow you to participate in an audience poll where you'll get to help choose the audience's choice out of the group that we're presenting. Hugh has prepared a brief discussion about CRISPR technology, and we're going to put that at the end of the presentation. There's been all kinds of questions about what is this technology and how does it work, and Hugh's one of the best people I know to explain it to us in simple language that most of us can understand. We'll move into Q&A at the very end of the session, and we do try to stick around, at least 2 or 3 of us do. We try to stick around until we've answered most of the germane questions that have arisen during the session. Let's not waste any more time. The Investing Roundtable is a discussion and a demonstration. We meet once a month, usually on the last Tuesday evening of the month, and the intent is for each of us to identify our single favorite actionable investment opportunity, our best stock at that particular moment. We do dabble in non-core selections as well as core selections, and we'll talk a little bit more about that in a couple of slides from now. And our goal is to put together a tracking portfolio that beats the market. Our immediate goal is to beat the market by at least 5 percentage points versus the Wilshire 5000. That's just a very broad index of stocks that we measure our performance again. We'd also like to see our accuracy. That means the number of stocks that are outperforming the market. We'd like to see our accuracy come as close to 60% or even beating it if we possibly can. The key, though, is that we'd like to keep this tracking portfolio at 5 points above the market. And here's our performance to date. Now that starts in our 3rd year. The graph's getting too big to display all on one screen, so you can still look at it. Our most recent performance is 18.8%, and that's compounded annually. And that's versus the Wilshire 5000 that during that same time period, with the same additions and subtractions, has garnered 13.6%. And if you do a simple subtraction, that gives you the relative return. Right now, as of today's close of market, we're beating the market by 5.2 percentage points. That's within our goal. We've been higher. You can see the graph's been higher, and we've been lower. That dotted red line is our goal, and therefore a couple of months in this year, we had fallen to the goal or slightly below, and now we've kind of clawed our way back above the goal again. To do this over 11 plus years is something that we're quite proud of. And this is the kind of goal that we suggest that investment clubs should be aiming at and trying to reach as well. Now, that doesn't mean you're a failure if you only beat the market by 3 points. That's still phenomenal performance, and that's still performance that's going to put a lot of money in your pocket. But right now, our relative return of 5.2% puts us in pretty rarefied atmosphere, and we're breathing the air and doing a little bit of giggling occasionally. Mark, anything to add to what I've said so far?
No, I think it covers it pretty well. The performance accuracy is down at the bottom at 54%. That's actually been steadily climbing, but I suggest that we all tip our cyber beverages in each other's directions and just press on.
Great. Oh, I did speak about core and non-core stocks, and we do like to keep our portfolio, at least for the last maybe 6 or 8 months. We've decided to keep those 2 parts of our portfolio separate so that people could understand what Mr. Nicholson was saying so long ago when he suggested that you keep maybe a quarter or even 30% of your portfolio in what he referred to as non-traditional investments. We've come to call them non-core. we've kind of done a list of what it means to be a core stock and what it means to us to be a non-core stock. The list is not exhaustive. I'm sure that we can all think of things we can add to either one of the lists, but we hope that we've given you enough characteristics of core and of non-core so that you can begin to tell the difference. The final analysis about where a particular stock in your portfolio fits, however, is up to you and whoever you share that portfolio with. It's something that's very personal many times, and you ultimately need to make the decision about which is which. Right now, in our opinion, our core stocks represent over $400,000 of the portfolio, and our non-core stocks represent just slightly under $70,000 of the portfolio. You can see where a lot of the growth, and that's sales growth, ladies and gentlemen, you can see that a lot of the growth is coming from our non-core section, and the overall growth of our portfolio is something that we've been working very diligently on for the last 2.5, 3 years to bring up to this number. We feel that performance is tied directly to keeping a robust sales growth in your portfolio. And to us, that means 11.5, 12, 12.5. It might even mean approaching 13 like we're doing right at the particular moment. These numbers come from weighted averages of the holdings. So the larger holdings contribute more to the characteristics than the smaller holdings do. You can see the aggregate quality of the stocks we hold is quite high. But you can see that for the non-core stocks, the quality becomes something that's just average, just in the middle at the 50th percentile. The par values, again, we're sitting 1/10 of a point out of the sweet spot for par. And for my money, that's close enough to say we're there. The sweet spot comes from Nicholson suggesting you should be able to beat the market by 5 points, and you shouldn't get greedy, and it's very difficult in his estimation to beat the market by more than 10 points. So with a market average based on today's market close of 5.6%, that's what that my par is, the average return in the market for these stocks in the manifest database, then the sweet spot becomes +5 to +10. Above that, there's that 10.6. We're at 10.5, and I'm going to call it a hit. An A with a slight blush of minus attached to it. Yes. Any questions out there so far, Mark? Go on.
Especially with that market that's been kind of hard to keep up with here over the last year. I think what I would like to do is just mention that we are tinkering with, we don't need to go into it tonight, but just put it on your agenda. We are tinkering with the notion that it might make sense to simply add the financial strength, the earnings per share stability, and the quality. See what you get when you add all three numbers together. And we're finding that, in fact, as Ken scrolls through the next couple of slides, a number greater than 210 seems to lean toward core. And companies that fail to meet that 210 total, that would be basically 70 times 3 or 210. It really is kind of lining up with this notion of, when you have a company with weaker financial strength, lower earnings per share stability, and lower quality, that's a non-core company. And adding those numbers together might give us an interest. We're going to talk more about that in future sessions and during our bull sessions, but just keep that in mind.
Absolutely. Mark's talked about bull sessions. If that sounds interesting to you, every Tuesday afternoon at 2 o'clock, we run a bull session. Kim joins us sometimes. Hugh joins us sometimes. Haven't had Cy there yet, but Cy's an awfully busy man, and we wouldn't expect the preacher to come and join us in the middle of the afternoon unless he was really on a day when nothing was going on. but it's a great time. It's a great discussion, and we would urge you to join us if you have the opportunity.
Maybe someday
Morning again,
when he's
Mark.
sitting in the stands at watching his Atlanta Braves, he can call in on his cell phone.
Call in, that'll work. Okay.
There you go. I'll have to see about that.
Here's the core part of our portfolio, and this is not the entire listing of the core, but it is going from the largest holding down. You can see the legend at the top of the screen, and that legend tells you how many different times that we've chosen some of these stocks. You can see that in front of Cognizant, right at the front of the legend, there's a 15X. That means that it's been chosen 15 times. So when you look down to Cognizant and it's in the third position, that means that $15,000 has been put into Cognizant over the time of the roundtable, and today it's worth 28,000 plus. You can see Microsoft. If you follow through there, Microsoft has been chosen 5 times. It's way over to the right on the top line, and in front of it is a 5X. So $5,000 in Microsoft has turned into just shy of $60,000. And again, this is over the time that we've been investing in the roundtable portfolio, and that's the last 11 plus years. Anybody have anything to say about anything that's appearing right now on this core list?
I don't know. I'm kind of in the catbird this month, so I'm going to go ahead and point out something like Costco. Costco is a one-time selection dating all the way back to 2010. Hugh made it, so $1,000 invested in Costco is now worth $7,500. I just find those fascinating, and it's kind of fun to watch that kind of stuff.
Axos Financial is another fairly new addition to the portfolio, and it's already been chosen 6 times, and it's moving right up the list right here. That Axos holding, I don't know, 5 or 6 from the bottom of the chart, is $6,000, which has become over $8,000 now, probably just within the last year. We haven't had that one in the portfolio for that long. The next slide that I'm going to show is the non-core holdings, and again, the top of the dashboard is showing the legend up there, and you're getting a list. Is this the entire non-core, Mark, or is there a few missing from this?
That's the whole non-core list. It represents 14% of total assets. It's the whole list, and I think I would urge people to look at Amazon.
Yep. We were having a discussion before the show began tonight, Mark and I were, that at some point in the near future, we'd like to have an open discussion in front of our audiences about whether or not Amazon still belongs on the non-core list. We're kind of divided on that. Sometimes we think absolutely yes, and sometimes the thoughts are absolutely not. When I take its financial strength of 98 and its earning stability of 45 and its quality of 74, I'm coming darn close to that 210 that Mark was talking about. And we both know, Mark and I both know, that 210 probably has some tolerance built around it, 210 plus or minus 10 or 12 points, because it becomes kind of gray when you hit that 210 on either side. But there's a good case, I think, that could be made for Amazon to be moved at some point from the non-core list to the core list. It won't change anything in the valuation of the portfolio, but it will tell the rest of the folks that are looking at the portfolio how we feel about that particular stock. Anybody have any input or any questions about the non-core holdings? I'm going to move on then. Oh, go on.
I was going to just make a quick, two quick comments about that. I would tend to lean toward Amazon probably having graduated from the non-core. And I'll leave that for the next discussion. The one thing that I would point out, what it can, from a portfolio management standpoint, make a difference is that we tend to be quicker to sell non-core holdings based on valuation, independent of portfolio concerns. Core holdings we tend to hold and sell for valuation purposes more based on the portfolio as a whole. So there is a consequence to the two of them, but you're correct. It makes no difference in valuation or anything, but you manage core a little differently.
Excellent point. Excellent point, Si. Well taken. Let's move on. We have a couple of hot seat stocks, and again, in the time before we began, Mark and I at least had a discussion that with our par right at the bottom end of the sweet spot, we didn't feel there was any emergency selling that had to be put forth, and therefore that leaves Booking, Forward Air, and Texas Roadhouse to live another month. There is nothing at all wrong that we can see, at least, with these stocks. It's just that their par right now is low, and many times a low par is an indicator of a very hot stock, a stock moving up in price right before the new par numbers are calculated. And it doesn't always happen that the two values, price and par, move opposite each other, but when a stock is doing quite well, its par many times will sink down to average or even below, and it's not reflecting the quality of the stock. In fact, these are three extremely high quality stocks above 90, and it's not reflecting whether or not the wheels are falling off either. The same thing's true about our one non-core holding. Si was right. We tend to look at non-core holdings and sell them or think about selling them when they move below my par. Well, this is the lowest par of the non-core group, and it's right at my par. My par was 5.6, and Tyson Foods par is 5.6, so it lives to cluck another day as well. One of our rule of five holdings that we might want to consider dealing with is A2 Milk. It's lagging the market right now by more than 20%. Mark was the one that brought A2 Milk to us, and he's pleading for a reprieve for at least one more month. So I'm inclined to give him his reprieve because he's been very kind to the rest of us at various times. So we're going to leave that one alone this evening. And we also have started looking at any stocks that have a relative strength index above 80. And Employers Holding is one of those. It's interesting to note that a couple of months ago, Employers Holdings was one of those stocks we gave a reprieve to. It had lagged the market by about 20 points, and we had to make a decision. Were we, in fact, going to move it out of the portfolio or not? Well, you can see since February how the price for this stock has done. That's a price chart beneath the RSI chart, which is the smaller one to the top of the bottom of the slide there. So Employers Holdings has moved away from being a laggard to being perhaps a little bit in the position that it's oversold, which might mean that you'd want to gather some profit from it at this particular time.
It's actually an overbought condition, so it's.
I said that wrong. You're right, Mark. You're right.
Yeah, and I'd like to just comment on this. I mean, a couple months ago, it was on the hot seat, and I think it's another time when I begged the governor for a stay of execution. In this case, if you look back 2 months towards the end of January, it was also at a very low relative strength. So you could at least make the point that it had perhaps it was oversold, undervalued, with a relative strength index down around 30. So I mean, you could do a little dance around that sort of thing. Now I can just feel Cy squirming about, you guys want to have this discipline, and now all this, me, wishy-washy, wiggling your way out of it type of thing. The market is really a humbling thing. When you look at something like Employers Holdings, in theory, with a recovering economy, they actually have more exposure to some of the problems of the things that they insure against. It's a workman's comp insurance company. It's just bizarre to see this company go from 30 to 45 in a matter of just a few weeks. But there it is, right there in front of you. So I do think it still merits watching closely, and probably belongs on a hot seat, especially if it continues to stay up there. And one last thought. One of the things that we do talk about, and maybe it's something we talk about in greater detail during a future session, is the stock can stay above a relative strength index of 70 or even 80 for an extremely long time. So you want to be looking at the quality of the company, the story, and not just react to that RSI all by itself. I think Kim would second that RSI by itself is just one piece of the puzzle.
Absolutely. You have to look at all the pieces of the puzzle.
Yeah. And I mean, I'm not a huge RSI watcher on either side, and you already touched on it slightly, Mark, but just notice that graph you went from around oversold to almost overbought for about a day within 3 weeks, and then is back up after about 5 weeks to well over 70, and has stayed there now for 3 or 4 weeks. So so it moved very quickly from one to the other.
Yep.
Cy, you'll be happy to know that I'm very gently nudging my chair towards yours on the round table, and that's to maybe say my original position, which was to heck with some of these other kind of indicators. But I'm not quite there yet, Mark. Okay.
Okay. Good.
I don't know why this one's here, so I'll leave this one for Mark to explain.
Well, why not? I mean, I thought it was kind of cute.
I like the last line.
Yeah. And with the tip of the helmet to Derek Green, who is a great guy out in Sacramento. He's a better investing volunteer out in Sacramento, so I just thought it was kind of cute.
Name Lance a lot. Okay, all right.
So our professional educator had to read this like 5 times in order to get it. Come on now.
No, I got it the first time. I'm just not certain that I think it's as silly as you think it is.
Oh, I think it's wonderful. Isn't that a great look? Just go to the next slide.
All right, we're on the next slide. Okay.
All right.
We're doing some screening here, folks, and you've seen this screening before. I'm not going to take the time to go across the tops of all the different columns, but here we are, just coming up with some stocks that were screened originally by being in the top 2% by manifest rank. And manifest rank is a combination of quality and return forecast. So these are pretty decent stocks on the list, a high quality, a fairly decent return. And now we're kind of looking at what's the opinion of different sources about these particular stocks. And Mark has collected opinions from the ACE community, that's the analyst consensus estimates, from Morningstar, from Value Line. We've looked at some technical analysis by looking at RSI. We've calculated our proved value. That's that value that we're taking a serious look at about whether or not it can be a check on your PE judgments when you're doing an SSG. And we're also looking at quality rankings, returns, current prices, almost anything that you can sort by. We're kind of giving you the number. And there's some interesting stocks that have moved to this list. I'm kind of surprised, Mark, to see some kind of, for want of a better term, vanilla health stocks moving onto this list. Universal Health, Athene, that don't normally screen out when you're looking at these kind of things. So that to me is interesting. I expect to see some of the ones that are up here, the Micron Tech, the Gentex, the Alibaba, but there's some on here that maybe are a little bit unusual. Yep. I know there's been chatter about Houlihan Lokey, and I considered presenting that this evening, except I wasn't as enamored of it when I got into it as some of the other folks that are chattering about it for. So I'll leave that for somebody else to choose at a different roundtable.
Well, I can use this as a segue to what I'd like to present tonight and just kind of close it up for you, Ken.
Okay.
I mean, this is just a list of 20 stocks that I built based on them being in the top 2%, they're 2%ers of the quality ranking in combination with the return forecast, as Ken said. And then what I did is I ranked them by the relative strength index. And I'm always looking for the companies that have been unfairly punished. And when the RSIs get low, again, I'm just looking for those opportunities, much like you would look for a low 52-week price. It's kind of the same type of concept. And as you work your way down the list, first of all, Auto Home is a Chinese company, so that's gone. LCI, economically sensitive. Green County, good study. Rio Tinto, that's going to be very economically sensitive, but it's got a lot of potential going forward. Malibu Boats could have some problem with the new tax laws. Companies like PetMed Express and Methode and Gentex and Newskin, all of those had insufficient growth rates. That's top line growth rates. Axos Financial still looks pretty good. Cy Lynch has been red hot here over the last several months, and he has nominated Axos Financial. That was the bank of the internet. It's been zooming along pretty well for us, but I didn't want to make a repeat selection. Alibaba is another Chinese company. Checkpoint is intriguing, but not quite enough growth. But again, just going down the list, and I was looking for a company to study. I also like the notion of Houlihan Lokey, but can't really warm up to it. And I got all the way down to number 20 for tonight's selection. A company with a 16% growth rate, a projected annual return in the teens, a good quality rating, a good projected return on value. An average projected return on value is about 6 right now. The relative strength isn't out of control. That upside position means that it's fairly close to its 52-week low. Value line isn't exorbitantly optimistic about it, but okay. Morningstar, fairly neutral to it. They think it's relatively fairly priced. But then I see the analyst consensus estimate. They think it's on sale, fairly significantly on sale. And then I also see a 1-year projected return based on their 1-year target price of 40%. So that's the one I kind of closed in on for tonight. So if you're ready, Ken, we'll just segue into that.
Well, Mark, isn't this on our best small companies list as well?
Mercury Systems?
Yes.
Yes, it is.
Yeah. Okay, so let's start into our presentations, and we're going to let Mark go first this evening rather than last, which is his usual place, and he's going to talk to us about Mercury Systems. So take it away, Mark.
Okay, so Mercury Systems, it's not a company that I'm all that familiar with. I had seen it listed as Mercury Computer as recently as a few months ago. They have changed the name of the company to Mercury Systems. I think it's a great change because when I think of Mercury Computer, I just couldn't get my thoughts off of the Commodore that's sitting across the desk from me, and that's not where you want to be with a company like this. They were founded about 30 years ago. They're basically working in the high-tech corridor with the Department of Defense is what this really comes down to. They get involved with first-tier suppliers to the Department of Defense, and companies like Raytheon, for example, and they basically act in a consulting / subcontracting role, and they're basically out there looking for solutions to a variety of needs, either to optimize on cost, as we'll see in a minute, but very highly regarded company within the halls of the Pentagon. And even when you go to Glassdoor, if you're not familiar with Glassdoor, it's kind of supposed to be a transparent, wide open look at companies. And you can look at companies with respect to their stewardship and the quality of leadership in the opinion of the employees of the enterprise. And they have a very high one. That paragraph that you see there is the value line close. And I would put this in the category of Hugh McManus's loathing. We do like to find companies that have a good long-term perspective, that are at least perhaps temporarily loathed, perhaps even hated. But this company has not gone up with the stock market. In fact, it even declined, and it's declined 21% so far this year in the first quarter. So there's been quite a sell-off, but the company's prospects have continued to look pretty strong, and they do seem to be behaving like a early stage Danaher with some of the acquisitions that they're doing. And if they do those well, they can be very strategic about it. Imagine acquiring a company that perhaps you've been previously competing with, that basically you take them in-house and merge them into your operations, and suddenly you have their network at your disposal, the opening of doors and access to opportunities. That's basically what they're doing when you put it down to the nuts and bolts on the hitting the road running. So go ahead and go to the next slide, Ken. I kind of like this presentation. It's from an analyst presentation from a few weeks ago. I think I really don't care for it when companies get kind of tripped up in their own buzzwords and marketing replaces strategy. But in this case, I think it applies. They're obviously going for 6 S's here and doing a marketing-esque type presentation. But when you think about what they're doing, innovation is so important, and silicon, they lead the way with silicon. So obviously on the chip side and on some of the material construction and fabrication material side of things for aerospace and defense, they're doing some great stuff. Safety goes without saying. They work with companies like Raytheon to really come up with safety and margin and risk enhancing opportunities. Security, very, very important area in our Department of Defense right now with respect to physical security and cybersecurity, and they're working in both of those areas. Speed is a crucial area that has been perhaps a little bit neglected. There's some fairly stodgy stuff that's gone on over the last several decades, and you see optimization. You'll see that in the next bullet. An optimization and a better approach to some of the things where they can shrink timelines for delivery and do some saving along the way, as it is with the swap there. They're doing their best to select the best materials, control sourcing, and basically optimize in ways that have not been approached previously, and doing a really nice job of it. And then last but not least, in the area of computer systems, on the consulting side, the software and all of that sort of thing. So it's one big mission, and they are supporting some very effective efforts in the area. When you think about the Department of Defense and how less boots on the ground, more cruise missiles is basically the really kind of cold way to say it. And these guys are one of the companies working on making the cruise missiles better. That's what it comes down to. Next slide, Ken. So I basically use a one-page assessment of companies when I'm thinking through this sort of thing. What you see here on the page is the visual analysis of the business model for Mercury Systems. You see a side-by-side comparison of the data array from September 2020 and then the recent update, March 2021. Well, what I want you to notice, basically the right side of the picture, is this company kind of coming into its own and kind of firing on all cylinders for much of the last 10 years. with very solid expectations for the next 2 or 3 years, and then out in that 3 to 5 year estimate from Value Line. So you see the top line looks good. The earnings, they did suffer there for kind of recessionary conditions there for a couple of years, but we see an up straight in the parallel on the right-hand side, which is fairly easy to imagine continuing. The profitability has been fairly consistent at 15, and we believe that that can continue. And then on the bottom right, you see that the PE ratio does seem to be maturing and settling into that 20 to 25 range. So you're basically talking about a company that currently has, again, it's a middle or medium-sized situation pretty much, with $841.7 million in sales. That's trailing 12 months. The slope of the business model line on the right is 16%. If you believe that they can achieve 16%, Value Line is actually slightly higher, but 16% growth, 16% margins, and a PE ratio of 24, that's down a little bit from 6 months ago. We are talking about a low single-digit projected return, and they have taken on a few more liabilities, a little bit less cash on hand, but the projected return on value is still in that superior 9% range. They did take on a little bit of long-term debt, but you can see that the banks loaned them $160 million at an interest rate less than 2%. That means that the banks have a high opinion of the company. The relative strength index, again, is moderate. Nothing to be too concerned about there, and it's at least a solid compared to the average company on Value Line right now, which is down around 2 or 3% for the long-term forecast. This one is a slight premium. Again, I'm not reaching for, although the cover slide was reaching for the stars and shooting for the moon, I'm not doing that here. This is just simply a gifted, talented defense contractor that's working with companies like Raytheon to serve that aspect of our government. So that's my pitch for Mercury Systems, and we'll add it to the roundtable portfolio.
Cy, you want to tell us about Regeneron, please?
All right, I'll be glad to, and I'll try and stay reasonably brief since Ken will follow on and be able to fill in any gaps in the company from his perspective, and then of course he'll give his judgments. Here you can see Regeneron relatively up straight and parallel, and you see the Value Line says that it's we of course don't watch and try and trade on technicals, but Value Line saying right now the market's favorable for it in the near term. That's what the technical analysis is telling you, and it says that it's not any sort of killer buy by their judgments, but certainly a reasonable, as Mark was talking about with Mercury just a moment ago, with the low projection of 7%, which is well above the Value Line median for low potential returns. Next slide. I came up with it just by starting with the portfolio, ranking by par. Decided I wasn't going to make Axos the next Cognizant, so I wouldn't do it again this month. And Regeneron was right there. And I've been looking at it for a little while, so I said, let's go ahead and do Regeneron. I like the growth, and I like the very strong financial strength as well as manifest potential return. Next slide. A quick check of the biotech industry ranked by quality. You see that only 2 companies make manifest excellent quality rating, and Regeneron's one of those 2, basically the same as Novo Nordisk, and it's got a solid return as well. Next slide. The company, they describe themselves, you can see here, leading biotech company that tries to transform lives. They're 30 years old, and they pride themselves in being led by physician scientists. They've had a positive earnings per share for 9 straight years, which is relatively rare as a track record for pure biotech firms, although we are seeing a number of biotech firms maturing and showing more consistent business models, but Regeneron is one of those. Next slide. Leading drugs, you see Eylea, Dupixent, and Libtayo. You probably are familiar with Dupixent from advertisements, if nothing else. They have an active pipeline, both looking for extended indications, new uses for existing drugs. Dupixent is one of the ones they're really pushing hard into other areas, as well as new medications. And I guess if there's a current big news on it is, and you maybe the other reason you're familiar with Regeneron is their antibody therapy to treat COVID-19 that has received emergency use authorization and has been purchased on at least 2 different contracts by the U.S. government. Next slide. And the next few slides come from a corporate presentation. They actually seem to update their presentation monthly, so I'd encourage you to go to the website and take a look and see, dig down in as much detail into the nitty-gritty as you would like. Next slide. This is just kind of a visual depiction of what I said earlier. You see the 3 main core brands that they said, then talking a little bit about how they're expanding into other areas, as well as both Dupixent there being expanded into pediatric asthma, and then some new drugs, and then some pipeline information. Next slide. Again, this is pretty much just another way of looking at their core drugs and the areas. And then notice in the far right that they really accent in infectious diseases, as well as some rare diseases. And interestingly, they're also looking at allergies, cat and birch they mention here. Next slide. Take a look at the expectations. And I think that it's interesting. Mark mentioned that Ken and I came up with this stock independently, and it will be interesting to see how our judgments compare. But the uncertainty of pandemic impact on medication prescriptions and the like, and Regeneron, as well as the inherent uncertainties of drug development and clinical trials and the like, leads to a wide range of expectations for Regeneron. You see Value Line projects growth of 10.6%. Morningstar is as low as 6%. Yahoo Finance 5-year earnings consensus is 11.1, but uncertainty can be opportunity. Next slide. Here's just the expectations from Finance Yahoo that gives you another picture of the range. Notice there's a wide range of earnings estimates for both the current year, 2021, and next year, 2022. But look, especially since we key on revenues, look at the range of the revenue estimates. That's a fair number of analysts. 21 analysts giving projections of revenues, and the high estimate is almost 16 billion, the low estimate a little under 10 for an average of 12, and then look at the next year. So you've got a wide range of expectations for Regeneron in the analyst community. Next slide. Here are my judgments. I decided to land around the Value Line growth of 11% growth. That compares to 15.2% growth by the Manifest consensus SSG, if you will. Net margin, I'm relatively conservative, leaving it around the current margin at 32.8. You can see that's well below the immediate net margin currently, and well below the potential margin that Value Line has. Now, I'm going to give back a little bit on shares Manifest consensus is projecting shares to grow. I'm leaving them about the same because I don't really see the growth in shares. The company has just announced a buyback of shares. Earnings per share, I'm a little below Manifest. I'm a little higher on the PE ratio, but about the same. And I come in with a projected annual return of a 9.6, a little below our sweet spot, but with all of that upside potential, as I showed some of the upside potential in the analyst estimates that are significantly above mine, as well as the Manifest par. I think that Regeneron warrants being added to our portfolio right now.
Thanks, Si. Before I start my presentation, I'd like to remind everybody to save the dates on May 12th, 13th, and 14th. Mark and Si and myself and some special guests will be presenting a series of classes. It'll be our third COVID cancellation conference. These are the days that the Better Investing National Convention was originally scheduled, and you know that it's now been moved to October. We hope that that'll come off without a hitch in October, but in May, if you're looking for something to do in the late afternoon, save the date and we'll be offering a series of classes. If you came to any of our things before, you know that they can be not only educational, but they can be entertaining as well. Let's look at Regeneron again, and this is the same process basically that Si used in order to pick up Regeneron. I've been kind of looking at stocks with high sales growth that are a small part of our portfolio, of the tracking portfolio. And my first choice this evening was Facebook. And I thought about it for about 10 or 15 minutes and then just thought that I just couldn't do it. I just couldn't put myself through a Facebook study again. So I moved to Axos. We've been choosing that quite a bit recently. So I went to the third one and the fourth one on the list. I almost went to LGI Homes, but you know, we've really been hitting home builders. I have real hard in the last 4 or 5 months. So Regeneron was there. It has a nice sales growth number of 15.2%. It's only 1% of the tracking portfolio. And that was the reason that I chose it for this evening. I also looked on the Manifest site where they tend to give me a mini industry study, and I found that Regeneron was the best one from Manifest point of view in the biotech industry, being followed closely by the ones that you see there on the screen. I then went to the Chronicle, and I saw that quality had dipped a little bit in 2019 and 2020, but it was on its way back up again. I was happy with that. I was happy to see that the par values, that's the red line on the Chronicle, were increasing. They weren't historically high by any means, but they were certainly higher than they've been in the last year and a half, 2 years. That was something that I thought was positive. I looked at the Regeneron page in Manifest, and Manifest was giving it a par value of 15.6. That's certainly nice and healthy. I wasn't sure that that would be my par value when I finished my SSG, but it was at least nice to know that 15.6 was coming from a consensus number from the analyst community. That's compared to a my par number when I did this study of 5.3%. I think it's 5.6% tonight. I went to Value Line and I read a pretty positive Value Line report. That last line in Value Line is especially positive, especially considering that the current price is a little bit lower than the price on the March 5th Value Line. So if they liked it at the price on the March 5th Value Line, then it's maybe even a little bit better today. That underlined stuff in the upper right, I found especially intriguing because just 3 or 4 days ago, the FDA extended the Regen Cove, and I referred you to the wrong underlining. It's the underlining in the left column. Just 4 or 5 days ago, the FDA extended the Regen Cove as an antibody therapy, and they extended it to the general population to be used at a much lower dosage. The bottom line of that is that if you can get 2 doses out of what originally was approved as 1 dose, then you're getting a lot more dollars for the amount of reagent or drug or whatever it is that you're going to distribute. So Regeneron automatically at these lower doses, which have been approved for emergency use, are going to be able to generate a much more cash from that ruling, as it were. Morningstar says some really nice things and puts a narrow moat around this biotech company. And to be honest, I had a hard time finding any other biotech company with any kind of moat at all. You remember that a moat is indicating that there might be barriers to entry into the market that they're looking at. And Morningstar feels that Regeneron does have a narrow moat, and you can read more about that from the Morningstar report. That authorization came from Crain's Detroit business on March 23rd, and you can see that if they were going to produce 750,000 doses at a higher dosage, then they would end up with somewhere about 1.5 million doses at the lower dose. They have a robust pipeline, and the one that as I was reading, the one that people seem to be really excited about was the one under, I'm going to try to find it right now, and I'm not going to find it on the chart. So I'll just kind of describe it. It was a juvenile asthma usage for Humira. And that's the wrong name. Dupixent. Dupixent is a drug, and I'm hoping that I'm not misspeaking myself. I'm going to leave that point out of my presentation, okay? Let's just say that they have a strong presence in their pipeline, and they have a very strong presence in genetic science and its applications as well. I can see that I've spelled applications wrong up at the top up there. Regeneron runs a genetics center, and they claim that they're the world leader in human sequencing with more than 1 million human exomes sequenced to date. These are going to move us into completely new classes and new types of drugs, and I think that's a real positive. Here's the regulatory, and it is Dupixent. I found it down here, folks, and this one people really seem to be excited about because it would be using Dupixent in an alternate way for pediatric asthma. And that would extend the patent on Dupixent, but it would also open up a hugely profitable market for this company if that comes to bear. Again, it's using Dupixent in an alternate way for children from 6 to 11 years old. Here's the lines up straight and parallel. You know, I was amazingly close to size projections. I chose 10% earnings growth as well. I think that's right where he was. My PE values, after I struck 2016 and 17, I used the last 3 years to give me PE values going forward. I get a pretty nice buy, a pretty decent upside downside, and I get a return of about 12%. That's a little bit more than Cy has, which means I'm probably using PEs a little bit different than he is, and I might be using net margins a little bit higher than he's using. But I think we're both in the same ballpark, and I would suggest Regeneron be another addition to the roundtable portfolio. Let's move to Hugh, and he's going to talk to us about, I'm not sure which stock Hugh's going to talk to us about. So go on, Hugh.
I'm going to talk about Gilead briefly. I hope everyone can hear me all right.
We can hear you just fine, Hugh.
Perfect. So generally, just I go through this review process every time, so we're reviewing a review here. Ideally, I like to buy what I bought already, and failing that, then I have to do the work to find something new. And this time, Gilead, and for a while, it's been hovering near the 52-week low. It's within 15 to 20% of it now. And it's a company that I would like to add to. So for that reason, I elected to add more Gilead to the portfolio. Gilead, everyone knows, went public, I think, in 95 or 96. It's been a staple of NEIC/better investing type people for many, many years. It's gone through a rough patch recently, and we'll chat about that in a second as we move on to the next slide, 41, a prime number. It is a former, I'll call it a former emerging biotech company. I would argue that it's a fully fledged pharmaceutical company at this point, as it has a very successful offering. It's profitable, and it pays a dividend. It has programs in just a rash of different things. The most well-known would be the antiviral, hepatitis C and HIV, but it's also in cardiovascular, inflammation, fibrotic disease, and more recently, in the last 5 or 10 years, thanks to acquisitions, it's moved into large molecules and cell therapy. It is to some extent a victim of its own success, show that in a second, but it is continuing into HIV and may hurt the company, but it will be extremely helpful to patients. And what I mean by that is, if you flip to the next slide, you can see the 10-year history, price history for Gilead, where in 2015, it had to pay the piper for its own success. It, through an acquisition, developed a cure for hepatitis C, which is a horrible potential disease that afflicts many, many more times the number of people in the world than does HIV. Certainly 3 to 4 times the number in the US. Back in the day, a lot of people were given hepatitis C maybe through non-sterile needles, things like that, in normal surgical procedures or clinical procedures, very small number. But it's a virus that spread pretty rampantly for a long time because it wasn't known, and it has a very long lag time before it starts to exhibit any problems, sometimes 20, 30, 40 years. Gilead developed a cure for this disease, and they suffered the exact same fate as Vertex did about a year earlier. Vertex came up with a drug that wasn't quite a cure, but really battered that virus down and made it undetectable. And all of a sudden, Vertex ended up with a drug within 12 months that went from 0 to $1 billion. It was the fastest drug ever to hit $1 billion. It's also the fastest drug ever to go from $1 billion to 0, because when Gilead announced their clinical results showing that not only did they get the viral load way, way down, but they actually had a cure for certain subtypes of the virus, there was huge expectation for Gilead. The stock price, as you can see, ran up, and it peaked in 2015 when they realized that other companies had joined on this cure for hepatitis C bandwagon. Because the virus had such a long lifetime before symptoms became apparent, doctors could warehouse patients waiting for a cheaper or better cure to come along. Gilead cure, the list price was $84,000 for an 8-week course of treatment. I don't think anyone ever paid that, but it was pretty pricey. And so the stock price, as you can see, has languished for a very long time, which for a long-term investor gives potential to buy it at a regular interval when it hovers around $60 or thereabouts. So we skip along. One of the things that I'm excited about Gilead is it has an extremely strong pipeline. It's in those 5 key areas where I talked about, but it has breakthrough therapy for quite a large percent of that pipeline. That's the FDA designating that the drug has the potential to revolutionize a particular space. So they give it this designation, which helps in the approval and the review process. The FDA will get very, very actively involved in that process. It's well worth going to the Gilead website and reviewing its pipeline. You can go through the list of drugs because for some of the diseases, particularly HIV, if we skip along to slide 44, they're actually using the word cure. They think they've come up with drugs that could potentially eradicate that disease from the body. There's one that I particularly have been following for years. It's a small molecule. Normally, when they target HIV and many viral diseases, they look at how the virus replicates within the body, it hijacks a cell, how it takes over the cell, how it starts to make more copies of itself, and they interrupt that biochemistry with various types of inhibitors. Gilead came up with a brand new approach recently, about 5-6 years ago, and said, hey, this virus has a protein shell, like all viruses do. COVID has one as well. Why don't we target the protein shell? Because that's the thing that when the virus mutates, the protein shell stays the same. And if we can disrupt the protein shell, we can make the virus vulnerable. And so that is what this antiviral drug, when it ends in vir, it's an antiviral, it's its generic name. And it's currently going through the clinic. It has breakthrough therapy from the FDA. Very novel mechanism of action. Certainly something to keep an eye on. And skipping along to the next slide, just highlighting some of the things in the portfolio. Gilead is growing through acquisition. They recently bought Immunomedics. They bought a number of years ago Kite, and you might have seen this CARTA advertised on TV quite frequently. It's what's called a CAR T. So it's an antibody. You take the body's antibodies, you manipulate them in some way so they target cancer or some other ailment, mainly cancer. You send it back in and let it do its work. Drug has been reasonably good. It's approved. Immunomedics, we wait to see how their drugs, these are antibody drug conjugates. So the antibody will target something specifically in the body, and you attach to that antibody a very poisonous, very chemically active molecule that only cleaves and breaks off when it gets to the cell where you want to do damage. And so it's a very specific way of targeting and destroying cells. But the thing is that this company is slowly pivoting away from its small molecule start to larger molecules, as are many, many different companies. And it did have a few problems recently with some of the proteases, some of the nibs and the tinibs that it had licensed from Galapagos in one case, and another drug that showed a lot of promise for NASH, which is a liver disease, but seems to have had a few issues recently. And I think if we skip along, I knew I was going to be talking about another topic, so I wanted to keep this nice, short, and sweet. I think the company is exceptionally innovative. In terms of revenue per employee, it is the single best in the pharmaceutical industry. It is going through a rough patch right now, and part of it is that it's a victim of its own success. If it comes up with a cure for HIV, and I expect that if any company will, it will be Gilead, you're going to see a huge jump in its revenues for a while. Other companies will be like hepatitis C all over again. We'll jump on that bandwagon. So it'll get a blip for a while. There is constant talk. AstraZeneca was the most recent one. Before that, it was Roche. But Gilead is a takeover target. And I imagine that is the case, that it could be bought out eventually. But probably, like most companies, they'll wait till the price starts to jump up a bit, and then they'll just push it up even more before they acquire it. It has pretty good dividend yield right now, 4% and change, so that's nothing to be sneezed at. But failing an acquisition, just looking at its pipeline, I think this company has a promising future. Nice stable revenues, they will keep growing at a nice clip. I think they will be added to by some of the acquisitions that it's bought and the new technologies that it has in its pipeline. So that is my addition to the portfolio.
Thank you so much, Hugh. Kim, tell us about ROAD, R-O-A-D.
Yes, I was looking around for a stock today, and I went to my special situations newsletter from Value Line, and this is a play on if the Biden administration gets through a bill on infrastructure. ROAD is Construction Partners Incorporated, is what they're called. This is from the March special situations newsletter, and they feel that the 3 to 5 year price target could be $62, and it closed at $30 today. So their compelling thesis is that this company has got a proven growth strategy and a strong outlook. They've got a great balance sheet. They've got $150 million in cash, and they've got borrowing capacity. This is the kind of company that you kind of worry about sometimes, because their competitive advantage is they have the vertical integration. They're only located in 5 different states in the southeast of Alabama, Florida, Georgia, North Carolina, and South Carolina. And their primary operations consist of HMA, which is essentially hot mixed asphalt that they use both internal and sales to third parties. So in other words, this is paving. They feel that it's a non-cyclical industry dynamics, and if we get the infrastructure bill on fixing our highways, this will, Value Line feels that this would be a company that benefits. They feel that there's a lot of poor and deteriorating roadways in those 5 states. State and local governments are increasing their funding for roads. Majority of the work, it's publicly funded for road repair and it's reoccurring maintenance. It's got a home-based workforce, and they believe they have 3 levers of growth by acquisitions, greenfields, and organic growth. Next slide. Here are all their locations. They have been expanding quite well, and if you see that little star over in the left-hand side there, that is where their headquarters are. They have consistently been buying up more HMA plants to expand their footprint. Believe it or not, they are one of the top 30 domestic heavy contractors, and this company has only been around about 6 years. They have a great record of expansion. All these slides were from their quarterly report from like March the 3rd. They are a serial acquirer in a fragmented industry, and they've had 25 acquisitions. And now they're when they are buying these HMA plants, they're strategically buying them so that they have the plants to have the asphalt wherever they need them. They're standardizing their IT systems, improving their bidding, job execution, and financial controls, paving the way for America's future. Next slide. All right, here's those 3 levels of growth in that fragmented industry. Most state and local governments are increasing fundings. They've got flexible crews and equipment to be able to get you to the location they need. They've got the strategically located HMA plants. They're synergizing with their operations and expanding their bidding opportunities. Those acquisitions, they have, believe it or not, they've got more than 140 HMA companies in the construction partners in the existing states they have. They're expanding geographically, and they've got the vertical integration of aggregates, liquid asphalt terminals, and the construction services. In total, the Department of Transportation represents the largest piece of the revenue pie, accounting for about 33% of fiscal 2020. Alabama and North Carolina Department of Transportation comprise the lion's share of roughly $786 million in revenue that the company pulled in last year, and no one exceeds more than about 10% of that. And as they are a serial acquirer, later on I've got a slide I want to show you on how I want to evaluate a serial acquirer to make sure they're not overpaying. Next slide. As you can see, they've got a proven strategy with their acquisitions. At the very bottom, you can see that they only had 2 to 8 HMA facilities, 8 to 13, 13 to 20, 20 to 22, 22 to 27. So as it keeps going forward, they're buying more and more, and they have their guidance for 2021 is $950 to $1 billion in revenue is their guidance. So they were held private in 2018. They had their IPO. So they've really done quite well. So next slide. From what I like to look at for under whether or not a company is paying the proper amount of money for doing serial acquisitions and can they incorporate them, I like to look under the Morningstar website under key ratios, financials, and then the balance sheet. I look under goodwill, and you can see for the trailing 12 months that is 7.38%. Anything under 30 is good, is what I'm happy with, because if it gets over 30, they're going to have to write that down and then the stock price drops. So in other words, you have got a company here that has a great management team with capital allocation and they don't overpay. Next slide. The significant southeastern U.S. infrastructure spending is, look how much it is negative, C, C minus, C plus, C. And local and state governments are raising the funding because the roads are awful. Everybody's complaining about it, and every time you travel, you can see where they're increasing the gas tax in Florida, Georgia, Alabama, North Carolina, South Carolina. They're building up the revenues to be able to do this. So they'll have the funds to be able to pave our roads and make them better. And it could be construction partners will benefit. Okay, next slide. This is from CNBC. I found from, I think it was this last week, that the president is expected to introduce $3 trillion in spending on efforts to boost the economy. And as you see that in red, rebuilding aging infrastructure like highways. So this company would certainly benefit from it. The Value Line article also said that if we do not get infrastructure, they really don't think it could be a deal breaker for this company because they've been going along and doing everything right anyway. But if we do have an infrastructure bill, they really feel that they could double the stock price could double in 3 to 5 years. Next slide. Here's their guidance. Revenue going forward. And next slide. You can see how their revenue has increased. You can see what they expect for revenue going forward from 43.8 first quarter of 2020 to 56.2%, even with the pandemic going on. It's amazing to think to me that they have $628 million in backlog that they have in this first quarter of 2021. That's a lot of backlog to get through. And that would be a lot of extra revenue for this company. Next slide. This is what the Special Situation newsletter had written on it, that they feel that they're a strong candidate to be a breakout performer in the coming years. Their catalysts include projected increase in federal infrastructure spending, economic activity strengthening in the southwestern United States, and aggressive growth through M&A strategy that should enable the company to expand further into new markets while enhancing their operational capabilities. Now this stock, when the market collapsed in March, it's up 60% from that, but based on their current earnings projections, they feel that they have a wide price appreciation potential to pull over 2024 to 2026. Next slide. All told, we have a 3 to 5 year price target of $62 a share and recommend a stop loss at 22 to prevent the downside risk. It's on the NASDAQ and it closed at $30.02 today. And thank you very much for considering this stock.
So if you give me just a moment, folks, I'll get our poll going right here. And let's launch the poll. If you'd help us out, we'll put $1,000 from the audience in the stock that you feel is the most worthy. You can also choose none of the above. We have about 3/4 of you voting. We'd love to get most of you out there voting. Let's see if we can push that vote to 90%. It's at 80% right now. It doesn't cost you anything. Just pick a stock and tell us which one you think we should be all set on. And I'm going to close the poll. And I'm going to share the results. And I don't know why you're not seeing them.
We are, I am.
I'm
You are
seeing them.
seeing them? Okay, I'm not on my screen. So, and it looks like we're going to put $1,000 extra then into construction partners. You can see that 34% of our audience thought that was very interesting. 30% on Regeneron, 25% on Mercury, and 11% on Gilead. So I'm going to hide that and move on to our next slide, if I possibly can. My screen is not frozen. And Hugh has agreed to talk to us a little bit about CRISPR technology. So Hugh, why don't you give us 5 or 10 minutes about CRISPR technology, if you would.
I'll try to keep it down to 5, put together a couple of slides. But CRISPR has been in the news a lot recently. It has been around for 8 or 9 years. It was discovered, well, it was applied about 9 years ago or so. And you can see what it stands for. It's a clustered, regularly interspaced, short palindromic repeats. This is something in DNA. We'll chat about in a second. Quick background. We have a genome. We have a lot of genes sitting on it. We'll talk about why it's important and what does CRISPR do to it. Those are the big things. It's an editing tool. Basically, it can go in and it can change your DNA seamlessly and then leave again and you're a different person. That's a glib description of what it does. So let's skip to the next slide, 61. If you think about IKEA, you're given raw materials when you go to the store. There's a set of instructions in there, and you get a chance to go and build something. That's what your cells are doing all the time. The instructions are sitting in your genes. The genes are just a sequence of what are called base pairs or certain types of molecules. There's an A, a G, a T, and a C. Those are the 4 letters that encode you, that make you what you are. And the sequence of those different letters can express a certain different protein. Change your eye color, make it taller, shorter, etc. Everything about you is encoded in your DNA. It's an instruction manual, for want of a better term. And when we skip to the next slide, there's a nice picture, I believe, of DNA. You've all seen this before. It's like a helix. It's like a ladder, if you will. Imagine a rope ladder where the rungs are actually 2 pieces connected together in the middle with Velcro. You can open it up and close it again, and that's actually what happens in the replication. You can see these base pairs, the A, T, G, and a C. An A is always associated with thymine, the T, and guanine is always associated with cytosine. And these are the 4 letters. These bases are the 4 things that make up a strand of your DNA, and when they're together, they're paired, an A to a T and a G to a C, so they're called base pairs. There are about a couple of billion of them in the human body, in our genome. Some animals have more, some have fewer, and a given sequence of these base pairs will make up a gene. So maybe there's a run of about 15, 20,000 of these base pairs is a gene. There's a certain sequence of base pairs that designate the start of a gene and a certain sequence that designates the end. We skip to the next slide. When the body is actually trying to read a gene, it can recognize the start and the end. If you want to read about this, it's fascinating to read it because how the body works is incredibly elegant. It's mind-numbing. It has to fill you full of awe. For me, there's a huge spiritual dimension to it. I have to say, it's incredible. But as I said, a gene is a segment of those base pairs. For a while, people said, or scientists believed, that a lot of what was in the genome, the DNA was junk DNA. They don't think that anymore, but there is some junk and residue and things left over from years ago in there. I mean, you could do a little bit of tweaking and all of a sudden humans could have a tail, if you will, or we could grow fins, and et cetera, et cetera. But as I said, it is a stunning system, how the body uses DNA to make more of itself, to create new cells, how it checks to make sure things have gone well. There's an incredible spell checker, which often viruses don't have. So that's why you get COVID running around mutating like crazy, whereas we mutate very, very slowly. So skipping along, CRISPR is a technology that allows you to change one of those base pairs. And it was discovered by two women who received the Nobel Prize last October for their find, because it is a phenomenal technology. They discovered it in bacteria, and bacteria in their DNA would incorporate sequences from various viruses. And it would use this information that to target a virus. So if it saw a virus with that sequence of DNA that it had in its own genome, it would send out a thing called Cas9, so you often hear of CRISPR-Cas9, to go and destroy that virus. It was a defense mechanism. I think I'll talk about that in slide 65, which follows. Yeah, it's part of a defense mechanism for the bacterial world. And these two women discovered this and thought, well, gosh, we could apply this to actually doing some surgery in DNA and changing a single base pair. And there are some diseases in humans, hereditary diseases. Sickle cell anemia is one, whereas in those 2 billion base pairs, those 2 billion rungs of a ladder, one of them might be an A instead of a T or a G instead of a C, and that gives rise to sickle cell anemia. And so the idea would be, well, you could alter that cell, the disease would go away. They're currently working, there's a lot of CRISPR companies working on some genetically modified diseases. The one thing which you're not supposed to do, and governments are very strict about this to date, at least anyway, is that you don't affect a germline. So in other words, you do not change the DNA of a molecule that is part of the reproductive process. Because if you do that, you're actually changing the code, the BIOS, the basic code for the human being. Now, we all know it will ultimately happen, and people will start to tinker in areas where they shouldn't. And there was an example a couple of years ago, maybe 2 years ago now, of a scientist physician in China who tinkered with the DNA and gave rise to an altered, humanly mutated offspring, which is a big no-no. But you can view CRISPR, the CRISPR part, as a guide, a template, what to target, and Cas9 is the workhorse that does this work. And it is a little scary. And I'll tell you why. If you skip to the next slide, and I'm just saying this for give you a bit of a chill. You can actually buy a CRISPR kit yourself and become a genetic engineer if you want, $169. A year ago, I saw a lot of them on Amazon. You could buy lots of CRISPR kits on Amazon. I went to Amazon today to take some pictures to show you how shocking this is. You can get it on Amazon. I couldn't find any CRISPR kits anymore on Amazon. So I don't know what's going on. And I don't know if I've got one more slide on here. I think I might. Yeah, but there are also what are called open source biotech labs. And there are a number in the Bay Area. There's some here. There's some in San Diego. That if you want to go and learn gene editing techniques, you can go and meet scientists and they'll show you how to do it. They'll show you how to use lab equipment. And CRISPR is really easy to do on your own at home, as you can see from that kit. So you can alter the DNA of a bacterium, essentially make a brand new life form. The FBI is watching this with a certain amount of awe and I think a lot of fear, but the government is not really interfering with it because they have determined that the more people that come off the street and learn about this technology are so scared by that, they're so impressed by the awesome power that exists here that they don't think there are people out there with kind of nefarious attitude towards it, and those that do probably signal it anyway. But I did find it interesting that you can't get CRISPR kits, or at least I didn't see CRISPR kits on Amazon. Maybe they weren't selling, who knows. But it is an incredible technology. We're going to change our own operating system, if you will. It has scary possibilities, but it has very promising possibilities to wipe out a lot of potentially hereditary diseases. And I think it's undoubtedly the very first of many amazing technologies, because there's a lot of things that the body can do, and we know they can do it, but yet we haven't been able to come up with a way to replicate that or do it in the lab. But CRISPR itself, CRISPR-Cas9, the whole shebang, is going to become dominant in medicine. So I hope that helps. Some folks asked for a bit of a review on CRISPR. I hope that helps.
Well, it certainly does, Hugh. It's a nice way to end and give us all nightmares this evening.
You're welcome.
And then we can all go out and buy our own CRISPR kit tomorrow.
Yes.
So we'll have a workshop on it. Maybe we'll replace one of the workshops at the COVID conference with a CRISPR workshop. We'll have to see about that.
Yeah, what creature have you named?
Coming attractions, folks. Our bull sessions are a Tuesday at 2 o'clock. If you need to register for those, you can go to the Manifest Investing website. On the public side, you don't even have to sign in. You don't have to be a member of Manifest Investing. But if you go to manifestinvesting.com, you can sign up for the bull session. Tuesdays, 2 o'clock Eastern Time. The April roundtable will be the last Tuesday in April. That's April 27th. Our COVID cancellation number 3 will be on May 12th, 13th, and 14th. Information to follow at the first week in April. That's pretty soon. And the NAIC National Convention in Dallas in the middle of October, and we'll have further information on that the closer we get to it. I'd like to give a huge thanks to Mark and to Cy, to Hugh, and to Kim. Mark was here tonight, even though there was a funeral in the family, and I'm sure that all of our thoughts are with him and his family. They buried his father-in-law this day, and Mark is certainly in our thoughts and prayers, I know. I'm not going to try to handle any of the questions this evening. I'm going to direct you to come to a bull session if it's a pressing question, and we'll try to answer it then, or come on back next April, and maybe we'll devote a lot more time to Q&A. Again, thanks to everybody that came this evening. We had a really nice size audience, and a special thanks to Cy and to Hugh and to Kim and to Mark. We can't do any of this without you guys, and I hope you know how appreciated you are. Good night, everybody.
Good night. Thanks.
Bye.
Good night, everyone.